All right, introduction to mobile home park investing. What is the mobile home park business model? What are you actually buying here? Well, we own the land and the infrastructure. That's the concrete pads. That's the pad that the home sits on top of. That is the land infrastructure. We're talking about pipes. We're talking about water, sewer, electrical wiring, and infrastructure. The roads, they might be concrete. They might be asphalt. So you are providing the infrastructure and the utility connections for somebody that owns a mobile home to go ahead and place their home on top of your infrastructure. Right? So it's a glorified parking lot. The tenant owns the home, you own the land and infrastructure, and it's a great relationship. They pay you lot rent and you maintain the grounds. And the result of that is that because the tenant owns the home, they are dealing with roof repairs, they are dealing with air conditioning units that go down, appliances that are failing, toilets that are having problems. You're not getting these calls as a landlord in the middle of the night when some of these issues pop up for, say, apartment building tenants. It's the mobile home owner's responsibility to maintain their home and the appliances within that home. The result of this is that the operating expenses are lower. There's less to maintain. There's no physical structures typically, except maybe a community center. And so the expense ratio is typically 30 to 40%, which compares great to an apartment building, which might be 50 or 60% of the total revenue that is going just to expenses to maintain the asset. Why mobile home parks then? Okay, so that's great, but why mobile home park investments? What else about this unique asset class is compelling? Number one, affordable housing is probably not going away. The demand for affordable housing is huge. I think most of you watching this video right now know that we have a crisis in this country. There's a large disconnect between what mortgage rates are, what mortgage costs are, and what rental units cost, and people are having a hard time keeping up. Incomes are not increasing as high as the rent and mortgage payments have increased the last few years. Every recession, there tends to be more and more Americans that come into the mobile home park ecosystem because they need to save money. There's more and more people that are retiring each year. 10,000 baby boomers retire every single day. And the vast majority of them have very little in retirement savings outside of their Social Security. And so we're talking about $100,000 is roughly the median that they need to last 20, 30, sometimes 40 years. With advanced medicine, we're probably all going to be living longer. So these people are going to have to extend their retirements. How are they going to do that? Well, affordable housing is one part of the solution. And so it's hard for me to imagine a scenario where the demand is going to decline. Who knows? But I like that bet. Number two, limited new supply. They're not building any more of these things. It is very difficult to get a new mobile home park development approved. You have to get it entitled. You have the entire community comes out against it because they think the worst. They think it's going to be a trailer park. Of course, it's not. The trailer park is what people think. That's the negative stigma in this asset class. There's plenty of mobile home parks that look like subdivisions. So it's an education problem, but that still means that very few of these are built. It's very unusual to have zoning these days where you can actually have a legal mobile home park operating and built. And so this prevents the new construction of mobile home parks, which is a great place to be as an existing owner of mobile home parks, because you're not worried about new competitors coming into your marketplace each year. And when you don't have new competition constantly driving returns down, that's fantastic when you own an existing property. And number three, recession resistance. We talked about this, about how we end up getting new entrants into the marketplace when we have a downturn or when somebody wants to sell their large home because they're retiring. They come into the mobile home park industry because they tend to not want to go to an apartment building where they're going to have somebody on top of them and on both sides when they're used to owning their own home. And so we've seen in the last three recessions, mobile home parks have continued to grow net operating income. That's a fancy way of saying profits despite the recession, despite the pullback in the stock market. The returns for mobile home parks are completely non-correlated, in my experience, to other asset classes because they just keep chugging along. They just keep slowly increasing lot rents that drive great returns year in, year out, and good income returns on top of that. And on the right here, the size of the opportunity, believe it or not, there's 44,000 of these communities in the country, and the vast majority of those communities are owned by mom and pop type of operators. They're non-professional. They tend to not have enough capital to reinvest into these properties. This represents a giant opportunity for professional investors to come in with new energy, new capital, professional operations to improve these assets. How do mobile home parks make money? All right. The primary income driver is the lot rent, which we talked about. You own the pad, you're renting it to the owner of that mobile home. The range is, believe it or not, $300 to $900 a month. It's pretty cheap compared to the average mortgage, which oftentimes is several $1,000s. Apartment rents can be the same. And so there is a large delta. There's a large value gap in between what it costs to rent a pad versus what it costs to rent or own a home in just about every market that we looked at. And so one of the cheapest ways to own housing is to own the actual physical mobile home, which new ones cost anywhere from $75,000 to $150,000 to own it outright, brand new. You oftentimes get to use one much, much cheaper. Buy a 1995 mobile home single wide for, 20 grand. That's in great shape. So retirees can own their home outright and just pay this lot rent each month to be able to tap into the utilities and to occupy that pad. And so that lot rent is the majority of the revenue. You can add additional revenue streams like billing back for utilities if the current owner is not doing that. That is oftentimes a great driver of returns because the tenants, if they're not being billed for water, they're wasting it. They're filling up pools in the backyard. They are taking hour-long showers because they're not worried about that water bill coming if the community is paying for everybody's water. So one route is to come through and sub-meter each of the spaces and then start billing back for usage. That's also good for the environment. You might have a laundry facility, a small little building that has a few laundry, washer, dryers, that can add some additional revenue. I don't think it's a great idea to do that because you add complexity in operations, but you come across these a fair amount. Storage units, that's an easier additional income stream, right? It's really easy to manage rental units. You just put a different lock on it and somebody stops paying the storage rent. Of course, abide by your rules in your market. And then RV storage, boat storage. This is pretty common with larger properties where you fence off one area of the park. And this is great additional revenue for the property. Most of the time, all of that revenue is dropping to the bottom line, which increases the value of the asset. And then to drive the point home here, the business model advantage is that you own the land and infrastructure, the tenant owns the home, leads to lower maintenance and longer term tenants, which is probably my favorite part about this asset class is you're not having this dramatic tenant turnover that you see in apartment buildings where oftentimes 50% of the rent roll can leave every year. What does that mean? That means you're having to come through with new capital, replace the carpets, paint the walls, maybe bring in a new fridge, redo the countertops. All that turnover creates a lot of additional capital requirements and expenses that you otherwise don't see in mobile home parks because maybe only 2% of the homes are leaving a community any given year because it's difficult to move these things. And so oftentimes when you have a mobile home that is brought into a community, it's there for life. It's there for 30 plus years. The tenants might only stay 10 to 15 years, but the homes rarely ever move, and therefore the tenant can sell the home if they want to leave to somebody else in the community, somebody else in the larger city, and then you just switch over who's on the rent roll and collect the new check from the new tenant. All right, what other aspects of this asset class make it so compelling? Number one, higher cap rates. On smaller deals, you can still see really high double-digit cap rates. Now, I don't advise most people start there. That tends to mean you're in a rough market with a really small park that's going to be pretty hairy. But you can go for it. If you're ambitious and you want a big turnaround deal that can drive giant returns, you can find them out there. At the larger end of the spectrum, we're talking 100 pad parks, you're rarely going to see anything for less than or for higher than a 5 and 6 cap rate because there's just more buyers that want that type of investment. Counterintuitively, those larger parks are easier to run because you can afford better talent on site, better employees to run their operations day to day. And this compares favorably to apartment buildings, which tend to trade in a tighter range of cap rates just because there's more institutional buyers and people that understand that asset class. There's just much more competition fighting for those types of deals. All right, we talked about the lower maintenance. Sticky tenants, once again, the homes rarely ever move. Once they come into a park or once you buy a community, you can generally rely on the homes being there for quite some time. We talked about how resilient these asset classes have been in prior recessions. It's not a guarantee, but the best data we have to predict future returns is how these properties have held up in prior recessions, and they've passed with flying colors. Limited competition, we've talked about the inability or the difficulty rather of building new mobile home parks. I would much rather own a business where I'm not worried about new competitors coming in and driving down my returns, stealing my customers like a knife fight for returns. I'd much rather invest in things that have some sort of moat. And in this case, the moat is the permit and the zoning to actually run a mobile home park at that location. Below market rents, most of these properties are owned by mom and pop. They have not kept up with inflation. They have not kept up with the huge spike in apartment rents, in housing prices, in mortgage costs, because the interest rate's spiking since COVID. There's a giant disconnect in market rents for lot rents for mobile home parks relative to apartment rents and the equivalent of a single family housing payment in most of the markets that we look at. Doesn't mean that you can jack the rents to market in every case year one. We definitely recommend people increase rents in a sustainable way. You want to take care of the tenants, take care of the property, but still generate a solid return for you and your investors. But the advantage in this space is the ability to increase rents steadily over time at an above average rate. That is a much smarter way to invest in the space, in my opinion. All right, the types of mobile home parks. There's two main types. We have all age and 55 plus. That's a senior community. The vast majority of deals that you're going to look at and find are all age communities. Those are generally going to be better opportunities for you. You're going to have a larger tenant base. There's going to be more opportunity to improve those properties. 55 plus parks tend to already be owned by maybe savvier investors. They oftentimes are more valuable in better locations. They're harder to run because the tenants are there the whole time, right? And they will contact you over very small things that need to be fixed. So I recommend starting with the all-age community first. That tends to be the opportunity set for somebody coming into this space new. And then you can graduate to 55 plus once you get more experience, more capital, and have lender relationships to acquire those more expensive communities. Breaking the mobile home parks down by size, a small park, 10 to maybe 30 lots. We've gone up to 50 here, but 10 to 30, you're generally speaking, you're going to see higher return opportunities because there's just not that many people that are chasing those smaller parks. You can develop relationships with the owners that are not getting bombarded with large, crazy offers from private equity firms. There's more dials to turn. You can oftentimes, with your own personal capital, buy these. You might even be able to pay cash for them versus having to go out and get a large loan from a bank. Medium parks, this is where the vast majority of smaller real estate private equity firms that raise capital from accredited investors, that's where they play. And then the large parks, oftentimes you're talking about the REITs, publicly traded real estate investment trusts, giant operators with billion-dollar portfolios. Large private equity firms like Blackstone, Carlyle play in this space, and they prefer to focus on giant communities, 300 pad plus if they can get it, just because you can drive more absolute dollars per transaction that obviously you can with a smaller deal. This is the mobile home park rating scale. 2 to 5 tends to be the range. There is a level 1. A level 1 is the stigma, is the stereotype that people think of when they hear mobile home park. They think trailer park with rundown roads, dirt roads, with dilapidated homes, with high vacancy, with just a giant amount of capital needed to turn them around and get them to a functioning asset. A 2.5 star park starts to look a little bit nicer. You're not worried about driving through it at night, and you can likely get it to a level 3 park with some love and some capital, a lot of paint to go ahead and fix up this asset. And when you get it up to a new level, you actually generate a ton of appreciation in that asset because you expand the buyer pool, you expand the universe of lenders that will lend on that property, you add liquidity to the asset, which is valuable. So level 3 is still going to generally have some wear and tear on the infrastructure on the roads. Roads might need to be replaced. The homes could use some fixing up. Oftentimes as the owner, you might even help out some of the tenants fix up their homes because to improve the appearance of the property, you benefit from that. You might be able to get a better refinance in a couple of years and pull out all your equity. So it might be worth it to help out some of the tenants that have let their homes go from a paint exterior appearance standpoint. Level 4 starts to look more like a subdivision, starts to look more like a stick-built traditional subdivision, might even have rolled curbs. You see nice landscaping, you might see a community center, some playgrounds, and a level 5 starts to look like a retirement community in Miami with bocce ball, maybe a small putting green. These can be retirement communities. They look exactly like a subdivision with really wide streets. The difference is instead of stick-built homes, they're manufactured homes that are sitting on a pad instead of set on a foundation. That's really the only difference for level 5. It's really hard to start at level 5. It's really hard to make great returns at level 5 because they're lower risk. They're oftentimes in great locations, and it's highly unlikely that they're going to see a lot of distress or a lot of vacancy at any given time. And therefore, family offices, insurance companies, they don't need very high returns. They just like stable coupon clippers. They tend to play in this space, and so I often do not recommend people try to pursue those types of properties. Me personally, my favorite is level 3, occasionally dipping into level 4 when we can get the opportunity, if there's still some room in the operations to improve the property, improve some of the infrastructure, justify a lot rent increase to generate attractive returns. But level 3 is probably the sweet spot from a risk return standpoint. You can optimize your potential returns for the amount of risk that you're taking, at least in my personal opinion, with level 3. All right, what is part of the value add strategy? Once you buy one of these mobile home parks, what are you doing to drive returns? Typically, you buy a park and you start injecting some capital in order to improve the operations and signal to the tenants there is a new operator in town. We're going to improve this park. You might redo the roads. You might spend some money on the common areas. And then that helps justify a lot rent increase. And once you do that, once you pass out the lot rent increase, you can see on the right-hand side the math of that. A $50 lot rent increase, which is not a substantial amount of money, right? It's not nothing, but you times that by 100, but nobody moves. Nobody gets super pissed at a $50 increase, especially if they know they've been getting a huge deal relative to apartments and relative to single-family housing options in that marketplace. They kind of know when a new owner purchased the property, professional investor from a retiring owner, people expect that there's going to be changes, right? Your property taxes increase, your insurance is increasing. So you have to justify a lot rent increase. And so the math of this is pretty compelling though. A $50 lot rent increase times a 100 pad park, that's $60,000 of extra cash that mostly goes to the bottom line. And if you just put a 6% cap rate, you divide 60,000 by 6%, that's $1 million of value that was just created from passing out that notice. Pretty powerful. Another common strategy, number 2, filling vacant lots, bringing in newer used homes to fill a pad. That's usually the fastest way to increase occupancy. Yes, you could put an ad for a vacant pad in your market and hope somebody moves in and pays for their own mobile home to be moved in, but it's much faster and more common for you to front the capital to bring in that newer used home and then sell it to somebody that wants to live in that community. Number 3, talked about sub-metering and passing the utilities on to the tenants. That's a very common strategy to boost returns. And then 4, of course, dialing down the expenses. Oftentimes you'll see park owners, mom and pop, because they're trying to create expenses because they no longer have depreciation to offset their income. From a tax standpoint, they will throw all their kids' car payments on the profit and loss statement. They will start paying for everybody's phone. They will put healthcare for all of their family employees. And I've yet to see a bunch of SUVs and college kids that are needed to run a day-to-day operation in a mobile home park, but you see this all the time. And of course, if you can cut those expenses, that's just as good as raising revenues because the dollars just flow down to the bottom line, which then you can apply the cap rate to it, and then you are increasing the value of the property. Financing options. 3 major ones are starting from left to right in terms of the size of the property. Most common to get seller financing when you're dealing with a really small park, or you might work with a regional bank, credit union, somebody that might require you to sign personally for that loan, which isn't ideal. I don't recommend it if you can get away without doing it. And then once you get to slightly larger properties, you get more of the regional balance sheet lenders. Some of them are willing to do non-recourse loans because they know the asset really well. And banks, lenders typically love this asset class for all the characteristics that we've talked about, generate lower default rates relative to their apartment loan books. their office building loan books, right? So they love lending to mobile home parks. And a subset of banks have really carved this out as a niche and are willing to work with people without personal recourse guarantees, which is ideal. And then once you start getting to larger properties, you can get institutional quality debt from Fannie Mae, Freddie Mac. These are the same lenders that are lending on giant apartment buildings. They lend to the majority of homeowners in this country, which is a nice vote of confidence for this asset class. They add a lot of liquidity to the space. They oftentimes are the best refinance option. Once you come in and improve a property, you bring NOI up, you can qualify for better quality debt from agency lenders like Fannie Mae. You can pull out your equity, and then you have an asset with non-recourse debt that's generating good income, and you have no more equity at risk. That is my favorite part of this business, is when you can refinance your cash out and still own the asset. And last thing on this is, whenever you tie a deal up, always try to get seller financing. It's so much more efficient and it's valuable because you can negotiate custom terms and deal with the seller directly. And it's just way easier to get that deal done versus going out and dealing with the paperwork and the hoop jumping that you have to do when you deal with a traditional lender. All right, so that was a quick intro to mobile home park investing and why it's so compelling. Here is the roadmap for this series. We are doing 10 lessons. We just did the first one. Here are the 9 upcoming lessons. The next one is how to find one of these deals to go ahead and buy. We love educating people in this space because affordable housing is such a desperate need in this country, and we want to see these properties run the right way. You can go to vintage-funds.com, or you can click below in the description to get there quickly. And we hope you watch the rest of this series so you can learn all about mobile home park investing. All right, thanks for watching.